Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak.
On July 30th, 2025, Jerome Powell, chair of the Federal Reserve, stepped up to the podium in Washington, D.C., facing a room of reporters and a global audience hanging on every word. For months, Wall Street traders, business leaders, and everyday Americans alike had been waiting to see, would the Fed finally cut interest rates, or would Powell keep pressing on the brakes? The answer? Rates stay put. But beneath the surface, Powell's language revealed far more than just a simple decision. He signaled both caution and confidence, a balancing act between celebrating progress on inflation and keeping America prepared for potential turbulence ahead. Today, on Wealth Decode Daily, we're breaking down Powell's full press conference, not just what he said, but what it really means for the economy, for markets, and most importantly, for you.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
On July 30th, 2025, Jerome Powell, chair of the Federal Reserve, delivered one of the most closely watched press conferences of the year. Investors, businesses, and ordinary Americans were waiting to see if the Fed would finally ease up on interest rates or continue holding the line. The verdict? No rate cuts, at least not yet. Powell announced that the federal funds rate would remain unchanged, and while that was no surprise to most analysts, what mattered more was his tone. It was measured, cautious, and deliberate, sending a message that progress has been made on inflation, but the mission is not yet accomplished. His words underscored a broader reality. The Fed is still navigating a delicate balancing act, trying to tame inflation without crushing the labor market or triggering financial instability. And behind the technical language and economic jargon, Powell's message had real consequences for Main Street, Wall Street, and Washington alike. Powell framed the Fed's decision as an exercise in patience. Inflation has been trending downward from its post-pandemic highs, but he stressed that it remains too elevated to declare victory. The Fed's target is a 2% inflation rate, and while recent data suggests movement in the right direction, Powell emphasized the need for greater confidence before easing policy. This choice of words is important. For markets desperate for rate cuts, Powell was essentially telling them to calm down. He was signaling that the Fed would not be rushed into premature moves. It's a familiar stance for Powell, one rooted in his awareness of past mistakes. Economists often point to the 1970s, when the Fed cut rates too soon, reigniting inflationary pressures that haunted the economy for years. Powell is determined not to repeat that error. For households and businesses, this decision carries weight. Interest rates are the invisible hand shaping everything from mortgage payments to credit card balances. By holding steady, Powell is ensuring that borrowing costs remain high. That means prospective homebuyers face mortgage rates near multi-decade highs, making the dream of homeownership increasingly difficult. Small businesses looking to expand must contend with expensive loans, slowing investment and hiring. On the other hand, savers benefit from high yields on CDs and money market accounts, a rare silver lining in this environment. This dynamic highlights the Fed's trade-off: short-term pain for long-term stability. Powell is betting by keeping pressure on inflation now, he can secure a more stable foundation for growth in the future. Much of Powell's focus centered on inflation. He noted progress, pointing to easing supply chain disruptions, falling goods prices, and a moderation in rent increases. These are encouraging signals that the Fed's aggressive tightening campaign is having its intended effect. Yet Powell also acknowledged the stubbornness of service sector inflation and the risks posed by strong wage growth. In other words, inflation has cooled, but it remains sticky in key areas. This is where the disconnect between statistics and lived experience becomes clear. While headline numbers show improvement, many Americans still feel squeezed at the grocery store, at the gas pump, and when paying rent. For them, the story of inflation isn't one of abstract percentages. It's the daily grind of managing household budgets under stress. Powell, of course, understands this gap. His call for more data before making any move reflects the Fed's attempt to reconcile these macroeconomic improvements with the realities ordinary people face. The labor market featured prominently in Powell's remarks as well. He described it as still strong, with unemployment low and job growth steady, though somewhat cooled from earlier peaks. Wages are moderating, a positive sign for inflation, but Powell made it clear that risks remain. If the labor market slows too sharply, it could drag on growth and erode household confidence. Here lies the Fed's dual mandate in action: price stability on one hand, maximum employment on the other. Powell is trying to walk a fine line, tamping down inflation without tipping the economy into a recession. It's a delicate task, and one where the margin for error is thin. Financial stability was another theme Powell addressed. He assured the public that the U.S. banking system remains sound and resilient, highlighting strong capital and liquidity positions. But he also admitted that vulnerabilities exist, particularly in commercial real estate and smaller regional banks. These remarks may sound routine, but they carry heavy implications. Just last year, several mid-sized banks collapsed under the strain of higher interest rates and poor risk management. Powell is determined to project confidence, but he cannot ignore the risks. For the average American, the reassurance that deposits are safe is crucial. For investors, however, Powell's cautious words are a reminder that not all corners of the financial system are equally strong. Commercial real estate, weighed down by empty office buildings and looming refinancing challenges, is one such weak spot that could create ripple effects in the months ahead. Housing and credit conditions remain a critical pressure point. Powell openly acknowledged that high interest rates are making mortgages and business loans more expensive. This is not a bug in the Fed system, it's a feature. Tighter financial conditions are supposed to cool demand, slowing the economy just enough to bring inflation under control. Yet this intentional squeeze has very real consequences. Younger generations find themselves increasingly locked out of the housing market, with affordability at crisis levels. Renters continue to see costs climb, while small businesses struggle to secure affordable financing. Powell presents this as necessary sacrifice, but the political implications are stark. For working families, it feels as though the Fed is prioritizing abstract inflation targets over their day-to-day struggles. For policymakers in Washington, it raises the question of how much economic pain voters are willing to tolerate. Politics, though never directly addressed by Powell, hangs over every Fed decision. As the 2026 midterm elections loom, inflation remains a dominant issue. Powell, while fiercely guarding the Fed's independence, is acutely aware that his policies have political fallout. He is criticized from both sides. Progressives argue that high weights disproportionately harm workers and marginalized communities, while conservatives caution that any hint of easing could reignite inflationary pressures. Powell's response has been to tread carefully, using language that keeps his options open. He avoids committing to specific timelines, instead repeating the mantra of data dependence. This strategy shields the Fed from political attacks while preserving flexibility in a volatile economic landscape. Markets reacted predictably to Powell's press conference. Stocks wavered, initially dipping as traders digested the reality that rate cuts remain distant. Bond yields held steady, reflecting the Fed's higher-for-longer stance. For Wall Street, the message was sobering. Investors had been betting on cuts by the end of 2025, hoping for relief from tight monetary policy. Powell didn't slam the door on that possibility, but he made clear it won't come quickly or easily. The takeaway is that volatility will continue. Every data release, every Fed statement will spark waves in the markets as traders recalibrate expectations. For households, this translates into uncertainty. Borrowing costs won't fall dramatically anytime soon, and consumers will need to adapt to a new normal where credit is simply more expensive. So what does all of this mean for you, the average American? If you're a saver, the news is good. Bank accounts, CDs, and money market funds continue offering unusually high returns. If you're a borrower, however, the landscape is tough. Mortgages remain prohibitively expensive, auto loans stretch household budgets, and credit card debt accrues interest at punishing rates. For investors, the environment demands caution. The stock market may swing wildly as it reacts to every new Fed signal, and bonds remain sensitive to shifting expectations. For workers, the outlook is mixed. Jobs remain plentiful in many sectors, but hiring may slow further, especially in industries sensitive to interest rates, like housing, construction, and technology. Powell's overarching message was one of patience. The Fed is not finished with its inflation fight, and the cost of declaring victory too soon could be severe. For households, this means staying disciplined, budgeting carefully, and avoiding risky financial decisions. For businesses, it means bracing for a slower pace of growth and adapting to a higher cost of capital. For Washington, it means facing the political challenge of explaining why the Fed's painful medicine is still necessary. Powell's press conference was not just a statement on monetary policy. It was a reminder of the fragility and complexity of America's economic recovery. As the press conference closed, Powell maintained his trademark cautious tone. He made no promises, offered no dramatic forecasts, and left every option on the table. It was a performance designed to project calm, control, and credibility. But beneath the calm exterior, the stakes remain enormous. Inflation may be cooling, but it is not yet conquered. The labor market is strong, but vulnerable. The banking system is stable, but exposed in key areas. The Fed is holding steady, waiting for more clarity before making its next move. For everyday Americans, the message is sobering. Borrowing costs will remain high for the foreseeable future, and relief will not come quickly. For Wall Street, it's a reminder that the Fed will not be bullied into hasty action. And for Jerome Powell, it's another chapter in his attempt to steer the world's largest economy through one of the most complex challenges in modern history. His press conference on July 30, 2025, may not have delivered dramatic headlines, but in its measured restraint, it captured the essence of Powell's strategy: slow, deliberate, and unwavering in the face of pressure. On Wealth Decode Daily, we'll keep breaking down what this means not just for markets and politicians, but for you and your financial future.